Welcome to the Way to Build Wealth. I'm Ethan Bloch, and I'm teaching you how to build some wealth. Welcome to the show on a Tuesday. And like we always do on Tuesday, a tea time, a Tuesday. And today I'm drinking a great, I think it's great, English breakfast tea. If you never had English breakfast tea before, you're kind of missing out. I personally like it in the morning. It gives you that real quick hit to the face if you need to get up somewhat early. I hate waking up. I'm sure everyone hates waking up, actually. You guys like waking up? No? 2 no's? Okay. So, real typical English breakfast tea, kind of heavy. I believe these have a good amount of caffeine in them. See, it's even said medium flavor strength. 3 tea leaves out of 5. And this is from Twinings of London. Straight out of Britain from our good old chappy friends over there. Yes. So, moving on with the show today. Last week we covered mutual funds, and more specifically, it was 2 weeks ago. You're right, time flies when you're doing so many shows and loving it. So we covered why mutual funds suck, and I left some big things out after I watched it again and realized we need to do a why mutual funds suck, a 2.0, 2.0. Why mutual funds really sucks. I can drive this home again. I got a little bit of hate email for this, but that's all irrelevant because mutual funds suck. And I'll talk about one of the emails at the end of the show. So the biggest thing that I left out is mutual funds are expensive. Lots of mutual funds charge obnoxious fees for underperformance. It doesn't make any sense. As I said in the last episode, if you missed it, mutual funds, the vast majority are actively managed, which means there's suits that are sitting there researching what stocks to buy, sell, hold, other things than stocks, and they're actively managing the fund, committing all these transactions, trying to beat the market, which on average, all of them as a whole don't beat the market, and then they're charging you obnoxious fees, more fees than index funds, which, if you remember, index funds mean you do as good as the market, you do average, and they charge you almost nothing in index funds. Mutual funds underperform and charge you more. My question is, why pay more for less? Take this year as an example. So this year is a pretty shitty year, no matter mutual fund, index fund, hedge fund, whatever. Some hedge funds are profitable, but one other day. Pretty shitty year in the markets. However, mutual funds as a whole have underperformed the market before fees. So if you owned an index fund, you still would have lost, 35, 40% of your money. But you would have got charged less for doing poorly than if you owned a mutual fund. And the biggest thing about that, I think, is if you own a mutual fund and you're down 45% on the year, you're going to start questioning the management of that mutual fund, and you're going to start thinking, oh, now I should sell it, and then I have to go do more research and find another index fund, another mutual fund that can rip me off. You're going to be thinking about this, like this right here. Dump your fund with a big-ass question mark. You shouldn't have to think about that. You want to know why? Because you should be invested in index funds. And if you own index funds, you don't ever think, oh, is this management good? Because there's no management managing the fund. You own the entire market. You don't have to question, what you're doing in this fund. You own everything. So if you're, anxious about stocks being down 45%, you own everything. So what do? You just buy more. Bare, bottom, basement prices. And if you're not invested in index funds right now, you got to get in. Because this, in effect, if you're buying at a really, really dire low in the market and you're buying an index fund that owns the whole market, you are, in effect, spring-loading your returns for the future. You're buying at a low, at an extreme low, and you will never probably have this opportunity again in your lifetime. Mutual funds 2.0, they suck because they charge you more for less, and you are relying on people. And if you don't have to rely on people, why would you? Humans have tendencies to be irrational and emotional, and that is extremely dangerous when it comes to investing. That's it. Enjoy the show. What's the typing about? Email. Thanks for reminding me. That's so great. Now I don't even remember what the email was. Right. So someone wrote in And they specifically said, hey, Ethan, you said mutual funds suck, but I own this fund over here that actually outperforms the market. So I wrote him back. I forget the guy's name, and I won't call him out. I said, that's great, but what are these figures based on? How long has it outperformed the market? 5, 10, 20, 30 years? I haven't heard a response yet. Furthermore, he's invested in this fund that's outperformed the market. But will it continue to outperform the market? Just because an index fund has performed in the past, just because a mutual fund has outperformed the market in the past, doesn't mean it will in the future, especially because you're reliant on the management. What if the management or the lead guy there, or the lead people or women, I don't want to be sexist here, want to, sorry, one day wake up and they're like, oh, I hate my job, I'm going to quit. You're invested in this fund for the long term and now the management just left, you're going to be fucked. Big thing to think about. I love that you are writing in, and again, feel free to write in, ask me some questions. You can follow The Way to Build Wealth on Twitter. It's just at TWTBW. We are constantly answering every question that comes in or pointing you in the right direction to get answers to your questions. Thank you for tuning in. We'll see you tomorrow right here on The Way to Build Wealth. I'm Ethan Bloch, and I'm teaching you how to build some wealth.